Hi, this is Zak Mir with the Bulletin Board Heroes here at Vox Markets for Thursday, the 19th of August. Starting off with Amore Minerals, which has managed to defy today's rather bearish look to the stock market with a further push to the upside. We were looking for 2.6 pence when the shares were around 1.952p, and so not too far off now. Maybe by the end of the month we'll get to that 2.6 pence level, and hopefully a bit more, given how straight the push higher has been for the stock. This stage, Eddie back below, I suppose, 2.2 pence, or sorry, 2.1 pence really, which was the initial resistance for the 2021, would really delay the upside scenario. Onto a stock which I don't really look very much at, which is Amrit. Here we've got a situation where the shares, if you're on the ball and eagle-eyed, you'll see that the shares have actually broken that line of resistance from back in March at £1.67, so an end-of-day close above that, and the 50-day moving average could take the shares up towards the 200-day line, currently around the £1.90 level over the next 2 to 3 weeks. This stage only really well below £1.60, which was the old May floor, really delaying the recovery idea and theory on that particular stock. Was a welcome change in sentiment towards Asiamet resources during the week so far, which is nice. There was also a massive spike in volume yesterday, which was even nicer, let's say. In terms of the near-term charting situation, we broke the 50-day and that line of resistance from back in April, around 2.25 pence, and above that we were looking for, and are still looking for, a move towards the 200-day line at 3 pence. That's probably the minimum on the upside one would expect with all that sort of excitement. Obviously today, not a great day for the market in general, so maybe a bit of a pause, but above 2.25 up to 3 pence per Asiamet seems viable. One of the best IPOs of the recent past has been Bellascura, and that's continuing to trade in that sort of positive vein. Just the possibility that there's a line of resistance at the top of this broadening triangle type formation from the end of May heading towards £1.10, maybe by the end of next month, and the upside here valid certainly while we're above the 80 pence level, which has been near-term support. In fact, 81, 82 has been the near-term support, so just 80 or below, decent stop loss ahead of a potential move to £1.10 by the end of next month. On to Blue Rock Diamonds, where it seems they're picking big chunks of the stuff off the ground almost on a daily basis. Here we've broken the February resistance line there and the 50-day moving average around 42 pence. While we're above that particular combo, and especially while we're above the 200-day line at 47 pence, let's call it, looks like the shares will head towards that gap at for the February gap around 60 pence by the end of next month. Moving along to a stock which has been popular almost from the start of, well, since it's come to market, Lithium Explorer. Brada ahead. Here we've got a situation where there's a likely trend channel target still there up towards 12-13 pence. That could be hit by the end of the next month. The longer we hold above recent resistance at 9 pence. Above 9 pence, looking for 13 or so by the end of next month for Brada at the moment. Stock which had a little bit of a hiccup, or I suppose because it's a helium stock, a bit of a burp, was HeliumOne earlier in the month. But the situation was, I suppose there was a clue to recovery with the bear trap from below the April support there at 10.35, so just a narrow bear trap and then flipped back above it, and we bounced off that again just yesterday. Today we've gapped up through the 200-day moving average of 13 pence, and the longer we manage to keep those 200-day moving average plus end-of-day closes in place, the greater the chance of perhaps a return back towards that old July floor there for the shares at 18.5 pence. I think that would make a reasonable target over the next 2 or 3 weeks. At this stage, only an end-of-day close back below the gap floor. Yesterday's high at 11.9 pence, really delaying the recovery argument, but a nice push for the volume as well above the 25-day average, so looking rather more sprightly. I think maybe the market's forgiven the company. On to a Novacyt, which revealed that it's managing to make lots of money at the moment, which is not really surprising given that we are forced to get tests, PCR tests, etc. at the moment. Here we've got shares building on yesterday's gap through the 50-day moving average and that resistance line there from May at £3.31. The target as described yesterday, was up towards the 414 peak from June. And now I think, given that we've managed to break yesterday's gap high day, so to speak, at £3.63, we can say that we're looking for a top of May triangle target as high as £4.75 now, especially while we remain above yesterday's £3.63 peak. So an end of day close above that high from yesterday should be enough to open up the prospect not only of 414 but up to £4.80. On to Pipehawk, which I think I've covered before, but can't actually remember doing it apart from the lines on the chart here. We had a very strong gap through the 50-day and 200-day moving averages just the other week. That was at 7.8 pence, let's call it. We've also now managed to break through the initial 2021 resistance of 9 3/4, and the longer we remain above that on an end-of-day close basis, the greater the chance of a move towards the notional resistance line projection from back in February last year, heading towards 16 pence. I suppose getting that line there from drawing that particular line through those resistance points from last year. So above 9 3/4, looking for 16 on Pipehawk. Stock which I've been accused of ramping, which is certainly not the case. I think covering would be the more sort of politically correct way of talking about it. Here we've got remote monitor systems. In fact, I'm including it today because I was accused of ramping stock. Here we've got the situation where the shares still looking as though they're bumping along the bottom, i.e. Near to that May support line there, heading towards 0.5 pence. That's probably the nightmare scenario at the moment on this particular run. So 0.5 pence, the likely low. So far, we bounced above it, even on a bad day in the market today. If you're looking for a potential bona fide entry point there on the long side, bottom fishing point, then that would be the old 0.7 pence low from last month. End of day close above that is really what would be the bear trap rebound signal, and then that would take hopefully the shares back up towards the 0.95 pence area of the 50-day moving average. Otherwise below 0.5 pence, and I think remote monitor systems not looking very healthy at all. We'd be looking at a much more bearish scenario wherever that line is heading, which is not a good number. So really, in the near term, 0.5 needs to hold, ramping or no ramping. Finishing off with Supply Me Capital, which is another stock I've been accused of covering, let's say, in the recent past. Here we've got a situation where the shares had that brief bull trap through the 200-day moving average. They managed to find support either side of the 50-day line. That's around 0.33, 0.34, so looking slightly better. The main thing, I suppose, here is that they hold that broken resistance line from the end of March at 0.28. Really back below that would not be a good look. So far we're holding that. And while we're above that particular line, then looking for a retest of the low to mid 40s there over the next few weeks. That's it for me today. More updates tomorrow.